How do you make an £850 million hole in last year's accounts? Ask the guys at Rolls-Royce, because IFRS 15 may be a simple concept, but it's caused some pretty big headaches. IFRS 15 is all about the timing of revenue in the accounts. It replaces a whole bunch of revenue recognition guidance, covers pretty much everything the old standards did, and must be used for reporting periods from the 1st of January 2018. The key difference is that IFRS 15 recognises revenue when the control of a good or service is handed over to a customer. So you have to decide whether control is transferred at a specific time or over a period of time. If it's at a specific time, the accounting is relatively simple. But if it's over a period of time, the revenue must be recognised bit by bit. To do that, you have to distinguish between the different performance obligations in a contract. That can mean restating all the numbers. A bit of a nightmare, you might think. It certainly was for the team at Rolls-Royce. They decided to restate figures for the previous year in line with IFRS 15 to reflect the new way they'd be recognising revenue, separating sales of engines from servicing. They saw a drop in revenue of about 10%, but the impact on profit was much more dramatic, a fall of 73% from 1.2 billion under the old rules to 321 million. How do you fancy having to explain that to investors? IFRS 15 is one of the biggest shake-ups to accounting in recent history. So here is our simple 3-step guide. 1. Make a list. Identify each customer contract and the performance obligations within it. 2. Break it down. Determine the contract price and divide it between the performance obligations. 3. Recognise revenue. Make sure you do this in line with the satisfaction of the performance obligations. Well, good luck with all that. And if you find yourself with some explaining to do, spare a thought for the guys at Rolls-Royce.